And it's a good morning from him, and it's a good morning from me. So let's head over to the studio. So hi everybody, hope you're all well. So welcome to Tivoli Studios. Welcome to my lunchtime live stream. It is Monday lunchtime, end of January at long last. It's been a long old month. Let's go online, sorry. It's been a long month. January is a funny old month, isn't it? It's always dark and it's just cold and all those horrible things. But anyway, we're here to educate, entertain, keep you informed of what's going on in the mortgage world. And things are looking a little bit better, actually. It's odd, isn't it? Bit of news, bit of good news here, bit of good sentiment, and the economy starts to move. Inflation slightly down. Bank of England saying they're going to cap the rates, put them up this week, but it's not looking too shabby actually as a sector. So we need to be happy with that, don't we, as we progress? Now, couple of things for you today. I want to give you a bit of a giggle in a minute about something, but I want to talk about pension planning, primarily because a lot of people who are into the mortgage world who want to think about maybe migrating to the financial advisor world are getting a little bit worried about it, and they don't think it's the same type of clients, and it's not, but it is, and I want to share that with you a little bit later as well. But before we go there, you probably, if you haven't heard about this last week, then you're on a different planet, aren't you? And it's all to do with the uproar on life assurance advertising by a company called Dead Happy. And I'm not going to put a judgment against it, but it does have a really big meaning for you as a mortgage advisor, mortgage and protection advisor. So let's just flick over to the slides now, because I want to share with you some of their adverts so that you can kind of see the kind of company they are. So let's just flick over to that one for you so you can see that. Those of you on the podcast, you can't see this, but I'll certainly narrate it for you. Now, this is a company called Dead Happy, and this is one advertising now. Why our life assurance is better, affordable prices, our guarantee. So quite an easygoing advertising, that one. But then they got a little bit more in your face. Deadhappy.com, life insurance plus death wishes. They're starting now to put like the pictures of dead people. Please die responsibly. What they've said they want to try and do is to shake the market up. And here's another one for you with a Grim Reaper looking like person. What do you want to happen when you die? Make a death wish, get it insured. They're selling life assurance. That's what they're looking to do to the younger generation, who might be a bit put off by the men and women in suits, which we tend to have this reputation for, don't we? And here's another one: Lucy's death wish, to pay off the mortgage and adopt loads of dogs. But big at the bottom, they're authorised and regulated by the Financial Conduct Authority. So it's a Pucker life insurance brokerage firm here, who offer life assurance to the younger generation. They're trying to appeal to them. You see, that's the whole point behind it. And then there's got one here called Cat 38. It just gives you a figure now. Pay out 90 grand, £4.97 a month. So they're playing on price as well, which of course is a key thing for everybody. But this is the one that got them into trouble. And you got here because life insurance, because you never know who your doctor might be. Now that guy there, Shipman, he killed like lots of people. He was a GP a few years back now. He killed loads of people, and it was pretty awful because they kind of crossed the line with this one, and they knew it too. But they're trying to get attention. Now, obviously, a lot of the younger generation probably don't know who that bloke is, but a lot of the older people do. And there's obviously a lot of relatives and family members who thought it was a bit below the belt. Anyway, the financial services life insurance industry, if you like, the broker world, we're up in raw time. LinkedIn was all over. How dare they talk about our industry? We're much more competent and professional in this. And it got me thinking, really. Anyway, they did apologize. Andy Knott there, never met the guy, but he sounds like a dude. In our attempt to be provocative and make people really stop and think about their need for life insurance, we have made a mistake, and for this we apologize. We will now go away and immediately review all of our current and future marketing to ensure that we learn from this mistake. He's got his leg between his legs and his tail between his legs, and he's off now. Andy Knott. He's probably having a bit of a giggle about the whole thing. He did step over the line, I must admit, but Dead Happy. The point, though, behind that story is they're trying to shake up the life insurance marketplace, and they're doing actually very well. A lot of young people go for it. They like the lower prices. They like the fact there's an app, and they don't need to see a crusty old financial advisor, you know, shout me down if you want to, but there are a few of those around in our sector, and they're all over LinkedIn. They were shocked by the advertising. How dare they interrupt our lovely cozy industry? It does make you laugh, doesn't it? But the serious point is, though, if you're a mortgage and protection advisor and you are selling protection in your mortgage application or post mortgage, whatever it is, an MOT, you've got to realize there is some competition. And the younger people, especially older people, man, what they are really, they will go online, they will start searching to see what's going on. So you've got to be good at getting commitment from your client, getting commitment from them to use you, and selling the fact that you are able to search the market. You can get really low prices if you try as well. So beware of that. Really, people will go to that advertising because although it's had a lot of criticism, it does attract people's attention. It's all over social media. I mean, people are sharing it all over the place. So just beware, there is competition, and they are shaking up the market. Rightfully so. I think our industry does need a bit of a shake. We're a little bit old fashioned. Come on, let's be honest, we are. We still have appointments, and there's still people with suits and stuff. And we go through sales process. We are regulated, but then again, Dead Happy's regulated, and they have a compliance department like everybody else. So they kind of get around those things. So think about the future on that one. Makes you think. It's quite fun. It's not funny at all. Actually, I'm laughing. Anyway, let's get on to something a little bit more serious, shall we? Let's get into financial advisor migration, pivoting, call it what you like. Hope you're well, by the way. Hope you're good. Hope it's all right with you. Enjoying January. Now, here's the context for you. Now, you may be a mortgage and protection advisor right now, and you might be thinking seriously about migrating to becoming a financial advisor at some point, either this year, next year, maybe to increase your business reach, to segment, to diversify, whatever it is your motivation. And a lot of people are thinking about it. A lot of people are writing to me, or nobody writes anymore. They're emailing me, write it on a postcard. They're emailing me and asking about my thoughts and opinions as to what they should be doing. And many, of course, are very reticent to do it because it's a big investment, big change, lots of exams, those sort of things. But many of them are reticent because they don't see how their current business model can move into a financial advisor model. And the first argument is they've got clients, they've got mortgage clients, of course they have, but they don't think the mortgage clients are right for financial planning. And that's where they're kind of stalling, if you like. So what I've got for you now is a typical mortgage client. I want to share with you in a case study how you want to be thinking about financial planning, particularly retirement planning, with this particular client, and how you, as a mortgage broker, mortgage advisor, can very easily swing into financial planning later on in the process without suddenly putting another hat on. You've got this hat as a financial planner, financial advisor, of course, that's what you like. So you're doing a mortgage, but you're also doing other things as well. So let me share with you the case study. It's useful CPD for you. If you're doing the CMAT 1, it's great to upgrade yourself on the knowledge, etc., on pension planning, because it's not that complicated. It can get complicated, but there's tech to do a lot of the heavy lifting for you as well. So that's the plan. So I'm going to head over to the whiteboard for this one. Now, the client that we've got, let's head over to the whiteboard, shall we? And we'll share with you the client that I've got in mind here. So good whiteboard. So hopefully you can see that very clearly what you are. I've got a couple of clients over here on our whiteboard. So let's put our clients here. I've got they're a buy-to-let landlord client. So that's very typical mortgage, isn't it? But they don't have to be a buy-to-let. They can be a third-time buyer. But these two people that we've got here in our little sort of pairing here are age 60 and 55. So yeah, a slightly sort of later life lending market, but for a landlord, that's not uncommon at all. And they're approaching retirement in the next few years, maybe, but they could be any age, doesn't make any difference. Now, this landlord couple, or they own their own business, so they are owner directors. They have put that in there for you. They have an SPV, a special purpose vehicle, which they're using to buy property, and therefore they are company directors of the firm. So they pay themselves a salary, so they are salaried, and that's important when it comes to pension planning. They are salaried, but obviously they have dividends as well. And they have a small company, so they've opted out. Now, that's something important. Opt in, opt out is to do with getting people who are employed to join the company pension scheme if there is one. If you haven't got a company pension, you have to set one up. But for small firms, you can opt out. So that's the situation. Now, these two people are married, civil partners, makes no difference what they are, but they're together. They're a couple. They have their own property. They have their own main residence, which is good. I mean, buy-to-let landlords have to live somewhere, so they've got their own main residence. So let's put a little main residence in there for you. The important thing about this main residence, and you may well have arranged for the mortgage on this as well, is that they have a mortgage on it. And it all depends on what term this mortgage is. It doesn't really make a lot of difference. So I'm going to put a bit of a timeline in here now for this couple. And just to give ourselves some direction here so we can see where we're going with the timeline, I'm going to go from today right into the future. There you go, on my timeline. Now, today happens to be 2023. It depends, of course, when you are watching this video. You might be watching this in 2024. It doesn't make any difference. Let's get a different red pen here. That one's dying, isn't it? And this particular mortgage is going to be repaid. I think they're looking sort of, 70 odd to retire. Now, again, gone are the days when people give up work at 65 or 66 or whatever it is. It doesn't happen anymore now. A lot of people, so buy-to-let landlords will carry on doing their buy-to-letting landlording thing way into later life, as long as their health allows them to do so. So when I talk to the couple, because I've been arranging their mortgages, by the way, that's my mortgage client. And when I talk to them about our next meeting, which will talk about their retirement planning, and we can see how it all links in together. I'd ask them, when are they looking to pack it all in? And I get the word 2035 is the time I get for it. 2035. Now, in 2035, the lady or the fellow, doesn't make any difference, will be, as you see, that's 12 years. So they'll be 72 and the lady will be 67. Now, the reason for that is that retirement age or state retirement ages kick in, don't they? State retirement age is 67 currently. So let's put this in here first of all. So let's start looking at what we've got. Now, we've got two people. Let's just draw a line down here so we can see where we are. We've got two people. We've got, here we are. We've got, there's the chap. It doesn't matter. It could be the lady. And remember, just to give you, this is the male and this is the female. But it could be male, doesn't make a difference. But that person's 60, that person's 55. Now, this person who's age 60 is also going to retire at 67, and they're going to get their state pension. Most people will get state pensions. Now, with state pensions, you need to do an inquiry as to how much money they're going to get. So you can go on to online.gov.uk, do a statement, and it tells you what state pension you're going to get. Now, this particular chap, let's put the numbers in for you, is going to get a state pension at age 67. Now, he's 60, so 7 years, so we're talking about 2030. So let's just put another, there you go. In 2030, this chap's going to be entitled to his state pension. But again, it could be a lady, doesn't make any difference. Now, if you did a search on what he's entitled to, he's probably going to get, in today's prices, about £8,000, about 8K per annum, which is okay, it's all right now. But of course, remember, he wants to retire at 35. The reason for that is that the other person gets their state pension a little bit later. This person who's age 55, they're going to get their state pension at 67 as well, but that's 12 years' time, which of course is 2035, as you can see. So they're going to get their state pension here. Yeah, state pension. They're going to get their state pension in 2035 because they're 5 years younger, which is fine, and they'll get probably about the same. Again, you need to do a check on that, about £8,000 or so per annum. Now, the geezer wants to retire at the same time as his partner, and that's fine. So what you can do, which not a lot of people know about, is you can postpone your state pension. So he actually decides not to take that and instead postpones it for a couple of years till 35. And if you postpone your state pension and don't take it, they actually give you more when you do take it, and it increases. I think it's 5.5% a year. Probably go up as well with inflation. Which means effectively, if he defers it, he could end up with sort of 11 or 12 grand as a pension when he reaches the age of 70. I think that's 2035. He's 60 now. So he's 72, isn't he? Obviously, he's got to live a few years to make up for the difference. But you see what we're trying to do now? We're now starting to give these guys an indication of how much they're going to have when they retire, what they got to live on. Now, obviously, there may be a buy-to-let couple. They might have a lot of property. We don't know that. We may not. It could just be a normal purchase that you're dealing with. Now, what else have we got? Well, people tend to come with baggage when it comes to pensions. People come with baggage. And it depends on who they are. You need to find out where they are. Somebody in their 60 or 55, they probably worked for employers at some point in the past. So a lot of people have previous pensions, which they've got. Occupational pensions were all the rage back in the 70s and 80s and into the early 90s. And when you ask the clients if they've got any pensions, they say, yes, we have. Now, the chap who happens to be the 60-year-old here has a couple of pensions already. He's got an occupational pension, which pays out when he's 60. Many used to, you see, because people joined them in their early 20s. They had to do like 40 60ths or 40 years service. And many people were allowed to retire at 60 or 62 or whatever. I had a pension with Eagle Star that lets me retire at 60. And this chap's got the same thing. So he's got an occupational pension here. Let's put that in the OC scheme. It's a final salary. And it pays out when he's age 60, which happens to be now because he's 60, isn't it? And when he dug it out, this actually pays him £2,000 per annum. There you go. A little bit of a nice little lump sum, tax-free lump sum as well. So he's well happy with that. But it's not a lot of money, £2,000 a year. But it all adds up. But he can't postpone that because that's not the way the deal is. He'll just have to receive that. So now, of course, in today's prices, at age 30, 2035, he will get 13 grand coming in, which isn't enough to retire on. And you need to find out what they want to retire on. But again, we're just looking at a plan here. Now, let's just take a look at what she's got on the occupational pension scheme. And she happens to have a scheme as well. She's slightly younger, 5 years younger. She's got a scheme again, but this pays out when she happens to be 65. Why? It just does. So she's 65 around about, what's she, 55 now? So she's 65 in about 2033, isn't she? So let's just put that in there, 2033. So you can see my timeline going on there. So when she reached 2000, she will also get her occupational pension scheme, and he did the maths on that. And I don't know, say for example, she's going to get 12k on that one. Again, plus a lump sum as well, which is nice. You can spend that. But now you see when she retires, she's got 8k from the state pension and 12k in today's prices. That's £20,000 when she reaches 2035. So the two of them are now starting to get a dual income coming in. He's got 11 plus, he's got 13 grand coming in, and she's got 20 grand coming in as well. Now that's from all sources so far, and that's great, but is that enough to live on when you hit retirement? Well, it depends on people's expenditure, but they might want a little bit more. They've got to pay tax on that as well. There is a personal allowance, of course, and of course that will be in future prices. But that's, you've got to weigh it all up. Is that enough? And that's when people start to think, well, probably it's not. So then you can start looking at what options have they got now to increase that. They haven't got long to go, this couple. So that's when you start to think about how you can help them. So by the age of 2035, so in 12 years' time, they want a little bit more money coming in. So what are the options? Well, first of all, you can certainly look at the property. They've got this property over here, this house with a mortgage on it. So let's hope the mortgage gets repaid. So you need to check when the repayment date is. And let's just say it's gone here. So that it's happy times, mortgage is gone at that point here, big smiley face there. So make sure that the mortgage is going to be repaid maybe by 2035. If you want to extend the term, make it a repayment mortgage, get rid of that mortgage, which then means that they've got a very nice property. Let's put the little property in there for you. Unless they move, of course. They got a very nice property, which, of course, you could do equity release on. Now, more and more people are thinking about this for retirement purposes. What's he going to be? 67 then? She's going to be, no, he's going to be sort of 72, isn't he? She's going to be 67 coming up to. So it's the right age for equity release. And then depending on the value of the property, they could certainly release a lump sum from that and spend it. If you release it and start paying yourself an income, there's tax situation, there's benefits being eroded. Got an equity release workshop tomorrow. And one of the biggest learnings that I give the IFAs on and the brokers on this training is that when you give people equity release money, it's best if they spend it. They don't spend it and put it away and invest it for an income. That affects all of their retirement benefits and all of their any other benefits they're in receipt of. And people might get quite a lot of that. And it affects their tax position, all sorts of things. But you have to think about that. So that's one option they could certainly look at. The other thing these two could do is they could start putting money into some kind of pension now. And that's the key here, isn't it? As a financial advisor, you'll be authorized now to give advice on pensions. If you're not authorized, people can go do it themselves, and they do. They open up their phones and they can go on to Vanguard or BlackRock or Hargreaves Lansdown. They've got some brilliant apps now. In fact, we do ours through Vanguard. Brilliant. You just go on there, tell them what you want, how much you're willing to pay in, and it organizes it for you. There's no advice, but all the funding is either passive funding or there's algorithms that do the investing for you. Very low charges, but there's no financial advisor involved. I know what I'm doing, but a lot of people do. It's not that complicated. So all you're doing is you're going to encourage them to put some money into a pension. So let's just get a different color pen here. So for this chap, you want to encourage him to put some money in, and you want to encourage her to put some money in into a new pension. That's all you're doing. That could be a SIP or it could be a personal pension plan. And you need to work out what they can afford. Obviously, there's limits. So they have salaries, these two. So you need to look at what their salaries are. But you can pay in, up to 40 grand or your salary. So if they're paying themselves, say, 12 grand, that's quite a lot of money, isn't it? They could pay £500 a month. There you go. £500 a month per month. They could start putting into their pension. And that's when you start to give advice, you see. Again, you don't need to give advice on this. You just go online and buy it. It's not complicated. So if you put £500 a month, so that's what, 6 grand a year. So it's well within their allowances. They could do it as a lump sum or monthly, whatever is easier for them. But they get tax relief. How cool is that? So that would immediately become £625 a month, you see, with basic rate tax relief. So already they got another 300 quid going in from the government. And if they're higher rate taxpayers, then they'll be able to get a bit more tax relief. How long that's going to last, I don't know, but it's still there. If the Labour government come in, which I think they probably will do in a couple of years' time, they've said that they're going to be friendly towards businesses. They may not change a lot of the tax situation, so they may keep high rate tax relief as well. But this goes into a tax-free fund, whatever that looks like, pension funds. And for this guy, you want to give that, there you go. What's that? A 12-year sort of term, isn't it? From now to there, that's 12 years. So it's got quite a long time to grow. And for hers as well, here we go. Let's put hers in as well. She's got, 12 years to grow as well. So tax-free, tickety-boo. So you could be looking at a nice little pot then, couldn't you? Maybe this would produce a couple of £100,000 with tax relief and growth. A £200,000 pension pot at current annuity rates is probably going to be producing, I'm thinking, sort of 10 grand. I don't know, 5 to 10 grand. Okay, as an income. Again, you need to run the numbers through. That's what tech does for you, Again, for her, she might be sort of looking at sort of 10k income either from drawdown. Actually, let's go for 5, shall we? From drawdown or from an annuity purchase. Annuity purchases, by the way, because interest rates and gilt prices are going up, are much more valuable now than they ever used to be. So you can use this lump sum or this pot to buy an annuity. So suddenly, therefore, it changed everything. So this guy's got 10k coming in from his new personal pension. He's got 11k from a state pension. He's still got the 2k there. So he's got what, 23,000, 24,000, which is all right. Now she's got another 10 here. She's got 18, and she's got she's got 30,000. So as a couple, they got 50 grand coming in as pension income in today's prices, of course, which ain't too shabby, really. They've got equity release if they want to release some lump sums to treat the grandchildren and all that kind of stuff, or to do up their house or to spend. So all is good. And the whole point is, you see, as a mortgage broker, mortgage advisor, financial advisor, you've sorted out mortgages. Now you're talking about their planning. And you're starting now to think about a pension for them as well. You do this meeting afterwards, of course you would. You wouldn't do it at the same time as the mortgage. This would be part of your review because they're your client. It's the whole point. You look after their needs and wants, etc., and you talk to them afterwards as well, which is key to the whole thing. So that's pension planning, quite useful, really, isn't it? It just makes you think about how it all hangs together. I hope that's been useful. Bye. Great work. Hope you enjoyed that. There you go. So think about it. If you are looking at becoming a financial advisor or financial planner or whatever, there are some steps to take. Of course, there are. You don't have to be just a wealth manager. You can be more of a generalist, really. You've got to get clients for that. Remember, tech will do the heavy lifting for you. Gone are the days, I think, where you'll be able to earn a lot of money, funds under management, because algorithms and intelligence does it all for people. You want to be planning them. You want to be helping them understand their life and work out where they're going and what they need to be doing. Mortgage protection, planning, pension planning, investments, all comes into their own. It's quite exciting, actually, if you can find people that are willing to do that. If you've helped them do the mortgages, then they trust you and like you. It's just logical for them to start using you for all their planning as well. So that's a little message for you. Okay, we need to wrap up because the time has come to an end. We've got quite a few things going on this month, so keep in touch with us on what's happening. We email you information, don't we? Other than that, have a great week. Enjoy February. Let's hope the sun starts shining as well. Enjoy February, and we'll see you all very soon. So let's put a little bit of music and say goodbye. Amen.